Economic downturns are inevitable. Markets rise, markets fall, and no one can predict exactly when the next crash will hit. Even seasoned investors have faced the shock of seeing their portfolios lose significant value in a matter of weeks. But there's a strategy that can protect your wealth, reduce stress, and ensure you're prepared for volatility: diversification. Diversifying your investments is more than just a buzzword. It's a proven method to shield your finances from downturns while still allowing growth over time. Today, we're going to explore how diversified portfolios work, why they matter, and how they can save you from financial losses when the economy stumbles. The first key principle of diversification is not putting all your eggs in one basket. Investing heavily in a single stock, sector, or asset class exposes you to extreme risk. If that one investment falters, your entire portfolio suffers. Diversification spreads risk across different assets, industries, and geography, so poor performance in one area doesn't derail your financial progress. This approach is essential during downturns when specific sectors may collapse while others remain stable or even grow. Asset allocation is the foundation of a diversified portfolio. Stocks, bonds, real estate, and cash equivalents each respond differently to economic changes. Stocks may decline during recessions, but bonds often hold their value or even increase. Real estate provides tangible assets that can generate income, while cash ensures liquidity during emergencies. By allocating investments across multiple asset classes, you reduce overall portfolio volatility and protect against severe losses. The right mix depends on your goals, timeline, and risk tolerance. Geographic diversification adds another layer of protection. Economic downturns rarely affect all countries simultaneously. While one economy may be struggling, another may be growing. Including international stocks, bonds, or funds in your portfolio spreads risk beyond your home country. Global exposure reduces reliance on a single economy and cushions your investments from localized recessions or geopolitical instability. Diversification within asset classes matters too. It's not enough to own only stocks or bonds, you must also diversify within them. For stocks, this means investing across industries like technology, healthcare, energy, and consumer goods. For bonds, it involves a mix of government, corporate, and municipal bonds with varying maturities. By diversifying within categories, you reduce the impact of sector-specific downturns and avoid overexposure to any one risk factor. Correlation between assets is critical. A well-diversified portfolio includes assets that don't move in perfect sync. When some investments decline, others may remain stable or rise. Low correlation assets act as buffers during economic downturns, smoothing returns and reducing overall portfolio volatility. Understanding correlations helps investors select complementary assets rather than simply increasing the number of holdings without strategic impact. Rebalancing keeps diversification effective. Over time, some investments outperform while others lag, causing your portfolio to drift from its original allocation. Without rebalancing, your portfolio may become overweight in high-risk assets, increasing vulnerability during downturns. Periodic rebalancing, selling portions of outperforming assets and buying underperforming ones, restores balance and maintains the protective benefits of diversification. Defensive investments strengthen portfolios. Certain asset classes are historically less sensitive to economic downturns. Consumer staples, utilities, and healthcare stocks often remain stable because people still need essential goods and services regardless of economic conditions. Including defensive investments reduces risk and provides steady performance even when the broader market is declining. Alternative investments can provide extra protection. Assets like gold, commodities, or hedge funds often behave differently than traditional stocks and bonds. Gold, for instance, is considered a safe haven during market turbulence. Real estate or private equity can offer returns uncorrelated with the stock market. Including alternative investments adds an extra layer of resilience against market swings and helps preserve wealth in challenging economic periods. Risk management is integral to diversification. Diversification isn't just about spreading assets. It's about managing risk intelligently. Understanding how each investment responds to economic changes, interest rate, inflation, and market cycles ensures your portfolio can withstand downturns. Effective risk management allows you to pursue growth opportunities while protecting your capital from catastrophic losses. Liquidity considerations matter. During economic downturns, access to cash becomes critical. A diversified portfolio should include liquid assets like money market funds or short-term bonds to cover emergencies or take advantage of market opportunities. Illiquid assets, such as certain real estate or private equity, may offer growth potential, but should be balanced with easily accessible funds to maintain flexibility. Dollar cost averaging complements diversification. Regularly investing a fixed amount across your diversified portfolio helps reduce the impact of market volatility. During downturns, this approach allows you to purchase assets at lower prices, boosting long-term returns. Combined with diversification, dollar cost averaging mitigates the risk of timing the market poorly while keeping your investments aligned with your long-term goals. Behavioral discipline is key. Diversification protects against risk, but only if investors resist panic during downturns. Many people sell when markets fall, locking in losses and undermining the benefits of a diversified portfolio. Maintaining discipline, sticking to your strategy, and avoiding emotional decisions ensures your portfolio can weather recessions and recover when markets rebound. Diversified portfolios reduce stress and improve decision-making. Knowing your investments are spread across multiple assets and markets allows for confidence during economic uncertainty. You're less likely to make impulsive choices driven by fear because the portfolio is designed to absorb shocks. Emotional resilience is a hidden benefit of diversification, giving investors clarity and focus when others panic. Tax-efficient diversification enhances net returns. Diversification should also consider tax implications, holding assets in tax-advantaged accounts, harvesting losses strategically, and selecting tax-efficient investments ensures that diversification benefits are not offset by excessive taxation. Smart planning increases net returns while maintaining protection against downturns. Diversification isn't static, it evolves. As your financial goals, risk tolerance, and market conditions change, so should your diversification strategy. Regularly reviewing and adjusting your portfolio ensures it remains effective. Economic downturns themselves provide insights into what works and what doesn't, allowing for fine-tuning to strengthen protection for the future. Diversified portfolios provide opportunities during downturns. When markets decline, well-diversified investors are positioned to take advantage of lower prices in certain assets. Cash or liquid holdings allow strategic purchases at discounted valuations, increasing potential gains when markets recover. Diversification isn't just defensive, it also creates tactical opportunities for growth. Generational wealth is supported by diversification. For those building long-term wealth, diversified portfolios reduce the likelihood of catastrophic losses that could derail financial goals. Protecting capital during downturns ensures consistent growth over decades, allowing portfolios to compound and provide security for future generations. Diversification is as much about preserving wealth as it is about growing it. Global economic trends highlight the importance of diversification. History shows that recessions, geopolitical events, and market bubbles are cyclical and unpredictable. Diversified portfolios spread exposure across industries, geographies, and asset classes, making them inherently resilient to these global shifts. Investors who ignore diversification expose themselves to amplified losses when crises occur. The psychology of diversification reduces panic and poor timing. When markets fall, investors with concentrated portfolios often panic, selling at the worst possible moment. Diversified investors, seeing balance across multiple assets, are less likely to react emotionally. This behavioral advantage preserves capital and positions the portfolio for recovery, turning potential disasters into manageable setbacks. Diversification is a long-term strategy, not a short-term fix. Its benefits are most apparent over extended periods. Attempting to quickly diversify in response to a crisis is often too late. Building a diversified portfolio proactively allows you to enjoy growth during stable periods and protection during downturns. It's a strategy of foresight, patience, and discipline, rather than reactive scrambling. Diversification supports financial independence. By reducing risk and smoothing returns, it allows investors to plan confidently for retirement, wealth accumulation, or other life goals. Knowing your investments are spread intelligently provides security and freedom, reducing reliance on income from work or other unstable sources. Financial independence is achievable only when risk is managed effectively, and diversification is central to that management. No one can predict when the next market crash will happen, but a well-diversified portfolio ensures you're not at the mercy of it. By proactively spreading investments, rebalancing regularly, and maintaining discipline, you protect your wealth, reduce stress, and position yourself to take advantage of opportunities when others panic. Diversification is not just a strategy, it's a shield that safeguards your financial future. Remember, economic downturns are inevitable, but portfolio losses don't have to be catastrophic. Spread your investments wisely, stay disciplined, and let diversification work as your safety net. By doing so, you can face uncertainty with confidence, knowing your financial foundation is solid no matter what happens.